Good evening. This is professional investor David Campbell, and I am really grateful for all of you to spend your evening with me on this webinar to learn about how to become a more profitable investor using passive real estate investment opportunities and group investment opportunities to increase your wealth, to make your life better. That's really the whole point behind real estate, is how do we get more hope in our life because we have control of our resources, or we've used our resources in such a way that our future is going to be brighter and better and happier. So let's talk about your 8 essential resources. And for the most people, when they're investing, the resources that they're working with are what I call the above-the-line resources: your cash flow, credit, and your equity. And for someone who's got a very high-paying job, you're a software engineer or a doctor, lawyer, something like that, oftentimes you are best off investing with your above-the-line resources and getting a professional or someone who is an active real estate investor to leverage their below-the-line resources. Because for a true investment to work, you need all of them, but for an investment to be passive, then your primary contribution is going to be an above-the-line resource. If you're contributing below-the-line resources, by definition, you're now actively involved in that process, and it's no longer passive. One of the reasons that we're attracted to real estate is retiring earlier than we thought possible, compressing time frames. Real estate gives us higher yields, and it allows us to take distribution or cash flow without depleting principal. And this is a really, really powerful idea. And that's why my whole brand is hassle-free cash flow investing. Because let's say you were to go buy something like gold, or you were to go buy something like a stock, and you have that equity, and in order for that equity to make you a profit that you can spend, you have to sell the equity. So you sell the gold, or you sell the silver, or you sell the stock, and then you have cash, and you spend the cash, and that's it. When you're looking at cash flowing assets, you have an asset that produces a dividend for you on a regular basis. And dividend producing income property is the most powerful investment vehicle that I'm aware of. There's other ideas behind creating a retirement earlier than you thought possible. This is just a teaser. Please talk to your tax advisor about this concept. But their rule IRS 72T, and you can Google that, and you'll go right to the IRS page talking about that. Don't do it now. Keep your eyes on the presentation. Let's stay present. But when you're done, rule IRS 72T basically allows someone to take early distributions from their IRA on a substantially equal and periodic basis without paying the early withdrawal penalty. So one of the rules behind hassle-free cash flow investing is there's no such thing as a good or bad property or a good or bad investment. There's only appropriate and inappropriate ownership and timing. You want to make sure that what you're buying is appropriate for you. You might have a buddy to say, hey, I've got the investment tip of the year. This is the absolute best thing. This is going to go through the roof. And it might be great for them. And you say, congratulations, go do it. And they say, do you want to get in? And you say, well, it might be a great deal, but it's not appropriate to me in my situation. So an investment that's appropriate brings you closer to your personal investment objectives, your personal goals. And if it does, then that is appropriate. And if it takes you farther away from your personal goals and your lifestyle objectives, then it's not necessarily an appropriate investment, even if it's profitable, right? Another thing is just the emotional cost of investing. Sometimes I've had clients buy very profitable investments, but they lose sleep at night, and because they didn't have the education or the training or whatever was behind that lose sleep at night factor, that became inappropriate for them. And so you've got to just know yourself and know it's appropriate, and something might be a great investment for your buddy and it might not be appropriate for you. As someone who works with passive investors in my projects, the last thing I want is someone to get excited about a high return on investment, get excited about the possibility of investing, and they write the check, and then for the next 10 years of that project, they lose sleep because they're worried about loss of principal, or they're worried about something in the investment that is really just not suited to them, or they're looking for something that's unrealistic to achieve. So your role as an investor, to be passive or active or both, right? I own passive investments where all I've done is written a check, and I am hoping that the sponsor of that investment brings me a return. I also am a very active investor. I use my below-the-line resources, my time, talent, relationships, and control of opportunities to bring a profit into my life. And so when you're looking at yourself and what's suitable to you, you can be one or the other, or both. The challenges of individual properties. Individual properties are always active. If you buy a property and you hold it in your name or the name of your entity, and you're the manager of that entity, and the buck stops with you, you're never totally passive because you're putting in your resource of time. Your management time is a resource. And you can find hassle-free properties, properties that are, really easy to manage, and they don't take a lot of your emotional resources to deal with, but they still take time. And as passive as you want to be, individual ownership of properties still take time. And then how passive is your income, right? You might be making thousands of dollars a month from your real estate portfolio, but if you're still managing your manager, then I argue that it's not passive. You just have a really well-paying job, right? You get a high return on your time investment. Both are good. I'm not knocking one or the other, because whole ownership of properties is great. I really love doing that. But just ask yourself, when you're looking at your time, if you're a high-income earner, it probably makes more sense for you to be passive. If you're a low-income earner and your skills and resources and relationships are more valuable than your time working, then you might consider leveraging your below-the-line resources and using your time to produce revenue through real estate. Anytime you have a high return on investment, it requires the use of leverage, where arbitrage, where you've borrowed the money at, say, 5% and you've invested it at, say, 9%, and you can make a 4% profit off the bank's money. So that arbitrage is what makes your individual return high. When you're using leverage, loans are hard to get right now, especially if you're trying to use retirement funds or if you need low interest rate loans. I mean, arbitrage only works when you can borrow at an interest rate below what your investing is. And so if you're investing at 8 or 9 and you can borrow at 10 because all you can get is hard money, that's not the right kind of arbitrage. You're negatively arbitraged. So when you're working with IRA funds, you have to have non-recourse financing, and non-recourse financing is expensive. And so when you're looking at opportunities to buy property directly with IRA funds, you might really consider a group investment, because in a group investment, you can get cheap financing because someone else guaranteed it. Maybe the general partner guaranteed it, or someone associated with the project is signed their name on the loan, so it's recourse to the bank, but it's non-recourse to you. And so you can get good interest rates there, good arbitrage there. Also, loans require good credit. I know a lot of people in this last economic cycle, they let go of properties, and they either did a short sale or they had a foreclosure or a deed in lieu of foreclosure, and now they can't get more financing. Maybe your debt-to-income ratio is not right. You've got a lot of cash. I also have a lot of clients that have lots of money. Maybe they inherited a lot of money, but they don't have any experience in commercial real estate. Even if you have the down payment and a good FICO score, a commercial lender may not lend to you if you don't have commercial real estate investing experience. So one of the ways to get that experience is through group investing. Group investing is when several individuals come together to pool their financial resources managed by a group of professional investors. So I have a team behind me. I get to lead my team, and I get to be the face of the company, but I have a lot of really smart people behind me. Having a team is a really important part of the process. And if you want to leverage a team, group investing is the way to go. When you invest in a group investment, it's limited liability to you as the investor. You're purchasing membership units or shares in a company, and you did not sign personal recourse on that debt. So even if the property eventually is sold at a loss, your total loss is whatever you wrote a check for. And that is a very powerful thing, because especially if you're a high net worth person and you're looking at diversifying your assets, you might pick up maybe 10 different assets, so you have 10% of your net worth in 10 different deals. But if you had signed personal liability on all of those deals, you might have 9 deals profitable, and one deal turns so upside down that it wipes you out because of that personal recourse on the loan. And when you're in a group investment, you don't have personal liability. Your liability is only what you write a check to the deal. If there is negative cash flow in the future, you can always choose to meet your negative cash flow or not. You know, when you have whole ownership of the property and you own it, you either make your cash flow contribution or the bank takes it back. That's pretty much it. In a group investment, that's not so. You have more options. There's ways to force equity without effort. You know, you can do development and you can get the benefits of changing a property's use or finding the needle in the haystack deal, but you didn't have to put the time in to do it yourself. You can leverage my time and my team and my resources and my brain. Group investments involve very little time, you know, for you, almost none. You make your investment decision, and then when the project has a milestone, we'll have an investment update or a video or a webinar or a phone call to take your opinion. What would you like to do? Maybe you have to vote on something, but there's almost no time involved for you as a passive investor in a group investment. That's the whole idea behind the management team. There's no hassle. Yeah, you never have to deal with the tenant phone call or the bank's calling or the tax guy. Really, everything is taken care of for you. When you're in a group investment, the manager, who is, say, me and my company and my team, we have a vested interest in the project doing well, because we make a property management fee, but that's just earning a living. We want the project to do very well because we're co-owners of that project with you. You know, we want the project to do well because when you do well, we do well. Also in group investments, we want to create a repeatable process, a duplicatable process, and scalable. Whether you've got $50,000 to invest or $5 million to invest, we can work to find those types of projects that are suited to your investment goals. I like to say deals attract dollars and dollars attract deals. So instead of me just investing my money, I can go to the marketplace and say, look, I have a great pool of investors that have been with me for years, and they like what I do, and they would like to invest in a passive way. So we could syndicate capital to do this deal. And so instead of just looking at my balance sheet and what I'm capable of doing, I can go to the marketplace and do much bigger deals. And because of my track record of syndicating and doing larger commercial projects, that puts me in deal flow that the average person is not in. Group investments allow you to do bigger and better opportunities, and it also helps you build credibility if you're a young investor. I remember one of my first syndications, I wrote a $75,000 check to participate in someone else's medical office building. At that time, I had never developed a medical office building ever in my life, but I wrote a check to that deal because I liked it, and from then on I could say, my partners and I are developing a medical office building in Texas. And that's a very true statement because my partners and I were. I was just the above-the-line resource guy. I put in the cash. My partner did all of the work. He was the below-the-line resource guy. But that gave me credibility so that when I wanted to develop my own properties, the banks and the sellers and my team took me more seriously. It was also a great way to, I call, earn while I learn, so that while that medical office project was going on, I was entitled to be a part of a lot of those conversations and get access to a lot of information that was going on because it was my property. I mean, I had someone who was managing it, but they were managing my money. I'm an owner, and I want to know what's going on, and that's a great way to learn. Earn while you learn. As we said, you can leverage other people's time, leverage other people's money, other people's knowledge, other people's relationship, other people's credit. you might put in, say, 5 or 10% of the money for a project. You might have 9 other people that put in the rest of the money. So you were able to take down, with your small chunk of money, a very large property. And so you are actually leveraging other people's money as well. Who should consider doing group investments? Busy people. People who want to earn while you learn, retirement funds. If you like doing bigger deals, if you want to get into more active projects, oftentimes the bigger the project, the higher the margin is. Right? In a small single-family house, there are a lot of people competing to buy that investment. When you get to a bigger project, a multi-million-dollar project, there are fewer people that have the skills and the resources to take on that project, and so the margins get bigger. And if you are a small fish, a small investor, but you want to tap into those higher margins, the way to do it is leveraging other people's resources. Active versus passive diversification, we talked about that. You might want to create your own big portfolio of houses yourself and do that with your own cash, but maybe your IRA you put into group investments, so you have passive diversification. Marketplace diversification is powerful too. You might feel very comfortable buying active real estate in certain markets. You might know your hometown or where you went to college or certain other places where you went on an investor field trip and you feel very comfortable, but you know, if you wanted to go to markets where you might not ordinarily choose to be in, but because there's a great opportunity and a great story and the marketplace is strong and you have a team there, you get to inherit my team, and that gives you an opportunity to be invested in multiple marketplaces without having to spend all of the resources to build your own team in those marketplaces. Also, product type diversification. You might say, housing is great, David, but in this recession I would really like to own medical office because medical office is very it's insulated from recession in a lot of ways. I also want to own discount retailer. I want to own the bottom of the market. I want to own the 99-cent store type of businesses because those businesses do very well in recessionary times. And I also want to own apartments because people are renting. Whatever you want to own, whatever your resources are, you can create more diversification by being in a group investment by having a small piece of multiple pies in different markets, in different product types, and different deal types. So the way that we make money with group investments is we're really looking for passive equity and passive cash flow, right? So passive equity is just the market smiled on you and the property went up in value. And that seems kind of a silly thing at this point in the market, but cap rates are very high right now. So we're talking about commercial property today, and commercial property is valued by its income. And the income might stay the same and the property value could go up just simply because investors are willing to take a lower rate of return. Right now, investors expect a very high rate of return. So even 3 years ago, investors might have bought a property at a 7 cap, that today they're expecting an 8.5 cap for that same property, right, just in a 3-year time frame. What that means is even though the cash flow is the same, the properties have come down in value. So today is a great opportunity to buy those properties at a high cap rate, and when investor confidence returns, cap rates will go down and people will pay more for the same income stream, and that's a windfall. So you want to buy when cap rates are high, they are, and you want to sell when cap rates are low. And right now cap rates are the highest they've been in a long time. So it's reasonable to expect that if history repeats itself, the future will bring us lower cap rates, which is great for people who are buying now. Found equity means you found someone who just got caught in an awkward situation and the timing was not right for them, so they're willing to give you their equity because you solved their problem in some way. Phased equity is, for example, you could buy a retail property that's leased for the next 30 years, and every 5 years the rent goes up. Every time the rent goes up, the property value goes up because the commercial property is valued on the income, And so rent increases on commercial property are a really big deal. And if you can predict what those rent increases are going to be, you can also predict what your future value is going to be. That's what we call phased equity. Forced equity is when you take something and you change its use, you add it value through construction or rehab or subdivision or some way you're forcing the equity in the property. And I like to do all of these in different ways. Investment objectives vary in each project. I would say we're looking at creating blended returns. And blended means we're going to take the equity growth, or what I often call an equity kicker, and we're going to add that to the cash flow, and that gets us our blended rate of return. For example, a property might pay you 8% cash flow, and you say, 8%, do I really want to buy something if it's only 8% yield? Well, what about at some point in the future, you're going to get an additional 12% per year in terms of equity. Because as the loan gets paid down, that equity is your equity. It's just not liquid. You can't spend it. Cash flow is liquid money that comes out to you on a monthly or quarterly basis or annual basis that you can spend. Right now, mainstream sources of passive income are not an option. The people that were investing for passive income for the last generation, the things that they use, the vehicles they use to generate that passive income don't work right now. Bonds and CDs are not outpacing inflation. You can get even government, federal government-backed bonds that are below the rate of inflation. And bonds, the interest rate on the bonds are at all-time lows. And when interest rates go up, then what that means is it's kind of like cap rates, right? So if you were buying a bond at a low cap rate, you're buying it at maybe a 1.5 or a 2 cap, and suddenly investors are expecting 4% return on their money for bonds, then the value of your bond is discounted substantially. You might lose a very large portion of the value of that bond simply by interest rates going up in value. And so bonds are not necessarily the safe investment that people think they are, especially when interest rates are at all-time lows. A stock market is risky and unpredictable. It's manipulated by governments. It's manipulated by currency. It's manipulated by the ERISA laws that require baby boomers to take money out. Robert Kiyosaki wrote about in one of his books where the baby boomers are being forced to take money out of their stock portfolio, but the Gen Y, the people who are between 20 and say 28 years old, they don't believe in the stock market. They are not investing in the stock market. They're occupying Wall Street. They're not buying Wall Street. So you have a whole generation that's selling, and there's no one buying. It's the ultimate Ponzi scheme. The buyers have gone away, and so what happens to values? They're very fragile. So I'm very nervous about buying an equity on the stock market. When you're buying into a group investment, you're buying something tangible. You're buying a piece of real estate. You're buying something that is dividend producing. And that's why, again, hassle-free cash flow investing, we want things that produce dividends for you on a regular basis. We also have a high risk of hyperinflation. All of the seeds for inflation have already been sown. They just haven't arrived yet in consumer pricing. The money supply is there. The banks have the money. It's just not in circulation yet. When that money goes into general circulation, we're going to see inflation happen. And when that does, you want to be well positioned in real estate, which benefits from inflation, and leveraged real estate. You want to have debt, good debt against your property, so positively arbitrage debt, so a cap rate that's higher than your interest rate, because you can pay that loan off with cheaper dollars. You might borrow $100,000, which is 5 Toyotas, and if a Toyota is $20,000, then that makes sense. 5 Toyotas, $100,000. You could potentially pay off that $100,000 loan with 2 Toyotas, when a Toyota costs $50,000. And the only thing that happened is our currency devalued. Anyway, I've written a lot about inflation on my blog, and I've got some great webinars about inflation if you want to know more about that. But why now? We're at an unprecedented time in history to take advantage of the real estate market. And for those of you who see the opportunity, but you don't quite have the skills and knowledge or the time inclination to dive head in first, being a passive investor is a great way to get involved. Prices are low, interest rates are low, sellers are flexible, inflation is looming, and there's nowhere else to go. There are I don't know of any other options that can produce dividends for you that are as safe as the real estate investments that we're talking about. Here is a typical market cycle where values go up, values go down over time. And what a lot of people say is, I want to buy at the bottom of the market. You tell me when it's at the bottom and I'll buy. And there's a couple flaws with that logic. The first is the bottom is 1 nanosecond in time. And when we hit that bottom, that nanosecond, you better deploy all of your assets into real estate as quickly as you can. But that's not possible, right? I've been working on deals that have taken 8 months to get to the place they are where I can present them to you today. And in that 8 months, the market is moving and changing. And so the way that most recreational investors shop is they say, if everyone's buying, I want to buy. When everyone's selling, right, I want to sell. And that's the opposite of the way that you make money. When everyone's selling, you want to buy. And when everyone's buying, you consider selling, right? So whether we're on the left side of that trough or the right side of that trough or somewhere at the bottom, nobody knows. Nobody has a crystal ball that can predict where we are in the market cycle. All that we can say with fair confidence is that we are a long way off that peak. And so we're somewhere in that trough. And if you look at market cycles, it doesn't really matter whether you buy at the left side of the trough and you go down before you come up, or you buy it on the right side of the trough and you go up. Really, the difference is just maybe a little bit of time. But if you're buying cash flow producing, dividend producing, income producing property, then the income is there regardless of what happens to value. Because value only matters at 2 times, when you're refinancing and when you're selling. And if you're not refinancing or selling, who cares what the value is as long as the dividend is coming in on a regular basis. That concludes the educational portion of our program. If you think there is a place in your personal investment portfolio for group investing, a great way to get started is send an email to david@hasslefreecashflowinvesting.com, and we can schedule a personalized investment strategy consultation to get you going. Look forward to hearing from you.